All right. So today I have a very special guest. Somebody that you hear from frequently, probably almost every Monday. We've been publishing an incredibly well-written and incisive column from Tim Price, who is a professional wealth manager in England, in London. And when I first met Tim Price, he was described to me by a mutual friend of ours as one of the only sound people in the city of London, one of the few people who actually gets it, who understands what's happening in financial markets, who understands central banking, who understands sort of the charade of these asset bubbles created by central bankers. And Tim and I hit it off right away. If you came to our event in Chile last year, you had the opportunity to hear Tim live and meet him and spend time with him in person. He's one of the most delightful people that you would ever be able to spend time with. And I managed to, after a couple of years
I think you have the wrong Tim Price.
Oh, wait, you're right. I forgot about that.
It's a very common name. It's common as Mark.
Yeah, after years of asking, Tim finally came down to this villa in Italy. It's become part of our annual tradition. We do our entrepreneurship camp in Lithuania every year, and towards the end of the summer here, it's always kind of sad. It means our summer is winding down, and it's time to get back to it. But we always come to this just beautiful villa in Umbria, in the Italian wine country. It's absolutely exquisite. The villa itself is several hundred years old, and it's huge. And it's basically just a company of friends and family, and some of our Total Access members come out, and just sort of interesting friends of mine who sort of trickle in and out all week from all over the world. And so Tim joined us today, and it is actually for that reason that Tim did not put out his weekly market commentary as he always does, and I accept full responsibility for that. But we thought we'd make up for it and sit down and chew the fat, as we were saying, and just talk about what's happening in the world and get Tim's take on everything. So again, first of all, thanks for joining us in Italy.
Thank you, Simon.
We can talk first maybe about we were actually talking about this last night. I think this was probably on bottle 4, as it were. We were.
It was my bottle 4. I think you're probably just bottle 3.
Yeah, mine could have been. And one of the things we were talking about. I was down at the other end of the table, and I heard this 4-letter word, GOLD, and I thought, oh, that sounds interesting. Anytime Tim Price talks about gold, and I got up and wandered down to the other end of the table, which, by the way, consisted of a couple of gals from New York who are in private equity, and a young lady from Malaysia who's a bona fide card-carrying revolutionary, fomenting revolution in Malaysia. And so, and Tim Price. So
eclectic
quite a group. And so anyways, it was the concept of gold. And one of the things, the words that came out of your mouth were, I think Warren Buffett is very disingenuous about gold, and of course this refers to his comment about if you take all the what was he saying? You take all the gold that's ever been mined, and it forms a cube, 90 feet long, 90 feet tall, 90 feet wide, and so forth. And Warren Buffett always says, how useless is that? You could have this big cube, or for the same sort of value of in paper currency, you could buy 10 Exxon Mobils and Walmarts, and buy every acre of productive farmland in America and all sorts of things. He said, how stupid would you have to be to own gold? Your take on this is what?
Yeah, I mean, it sounds really ridiculous to be having a pop at the most successful investor who's probably ever lived. So what I'm picking up, where I'm challenging Buffett when he makes that comparison, is it's not a fair comparison. It's not an apples with apples comparison. So, yeah, I entirely accept that there's value in having real assets and productive assets, and gold is not a productive asset. It's a sterile. It's a sterile thing. It's arguably a commodity, though I'd prefer to view it as a money. It's certainly a money as far as I'm concerned, but it's a store of value. So the fair comparison, if you're going to make a comparison between types of money, would be a cube of gold versus the equivalent value cube of dollars or pounds or euros or yen.
Right, exactly. I mean, if you were to look at a cube of paper money that's $5 trillion, tens of trillions of dollars, if you took all kinds of different real assets and forms of money in the world, it would probably be certainly bigger than the cube of gold. But yeah, it would be equally pointless to have a stack of paper versus a stack of metal. Neither of those is a is a productive asset. But if you have to choose, one or the other to actually be a store of value, it seems like a no-brainer.
And the thing worth bearing in mind is also this sort of where you are on the continuum of time. So in the very short term, very, very short term, then, it makes sense to have liquid assets. And I dare say sort of cash money or fiat currency is one of those. But over any meaningful time horizon, there is no comparison. So I think the figures we were looking at or just discussing last night were, over the last century, the US dollar, and the US dollar has not been the worst performing paper currency by far, but the US dollar has lost something like 98% of its purchasing power. Gold hasn't. Gold's been fine over that period. So that's taking the long view, I think, is perhaps worth doing from time to time.
Yeah, it's a very interesting perspective because the date. I mean, this is just obviously there's all kinds of publicly available data on this, and so the publicly available data going back not just decades, but literally hundreds of years, in many cases even thousands of years, when gold was really used as a currency, is that the long-term preservation of purchasing power is very clear with gold, to the point that you could actually look at a lot of different products and services back to the ancient times that were denominated in gold or silver, and see that in many cases many of these prices are actually quite similar, such that it really does hold its purchasing power. One of the things that I've recently come across was the payment that Leonardo da Vinci was given later in his life by the King of France. And it was I think it was actually in gold florins or ducats. I can't remember which one now. But it essentially that if you look at the value of the melt value of the gold that he was paid at that time, it's roughly equivalent to probably about what he would be paid today for doing comparable work. So, and of course, that was a time when he wasn't taxed on his earnings as well. So there's that. But the long-term trend is pretty clear about how gold holds its purchasing power, and the long-term trend is very clear that paper does not hold its purchasing power. So, I mean, the data is so obvious, and it makes me just even wonder why there's still an argument about this.
I think one of the issues is that with modern technology, with global sort of instantaneous communications, with the web, with thousands of media channels out there, that everyone's got massively short-termists. So a lot of investors think literally sort of day to day. There's still a kind of day trading perspective that sort of permeates the markets, and that requires prices to move, and it requires momentum behind price action. So gold, in dollar terms, has basically has been a bit of a disaster for the last 2 to 3 years, and as a result, a lot of people have lost interest. I can understand pricing and trading from a momentum perspective, but what that critically misses is the fact that I think we're living through a perhaps uniquely challenging period in financial history. That I would defy anyone to show a period where there's been more sown in terms of a potential harvest of volatility and risk. I doubt whether anyone can cite a period previously to this in history where you've had so much money created ex nihilo, out of nothing, by so many different central banks. And, so we're now in, 6 years after the sort of financial crisis first really, went large with the failure of Lehman Brothers. And you've had literally trillions of dollars created, and, pounds and euros and certainly yen now. And there's a sort of general sense, it seems to me, that for a lot of investors, the worst has passed, the storm has passed, and I think that's profoundly incorrect. It strikes me that the situation is a lot more perilous now, and I should stress, I have no dog in this fight. I'm not seeking to profit from falling prices in anything. All we're trying to do for our clients is simply trying to protect their purchasing power in real terms over the long run. And it just strikes me that there are some really almost tangible risks out there that aren't being appreciated. And one of them is that, we've had, 5 years or whatever of bubble blowing by the Fed and by the world's major central banks. And by a process of elimination, the only game in town is punting in the stock market now. So, all we've seen really is, scientific proof that if you print a truckload of money, you make the stock market go up. But that doesn't mean the stock market has necessarily, inherent value. It might be grotesquely overvalued today. I think some markets are fair and some markets are frothy. But there's this general perception that The only game in town is to be in stocks. And, there's an expression in the market, don't fight the Fed. And by and large, for most time, that's kind of broadly worked. You don't want to be tackling the Fed or any other major central bank head on because you're not going to win that fight. But it strikes me that everyone's in on this. Everyone's doubled down on that bet. So everyone's now saying, oh, no, the Fed's sort of back and it's now Janet Yellen. But it doesn't matter. There's still a Yellen put and everyone will be all right. And the fact that view is so popular and so widely held gives me real nervousness.
What's your view on? Obviously, I agree with you. I mean, I think there's substantial indications in so many markets out there that there's tremendous risk being taken by people who are jumping into the markets at their all-time highs. And you're right; it's become the only game in town. And I think about how people, in order to, I mean, if you hold cash in a bank, what is considered, I'm doing the air quotes, and safe, you are guaranteed to lose money. You're guaranteed to lose money.
But it's not just cash in the bank though. So you've also got probably the world's largest asset class, namely debt.
Right.
And I cannot think of realistically a single major part of the credit market globally, whether it's government bonds or corporate bonds, or certainly high yield bonds. And there's not really. I mean, there are maybe tiny pockets of sort of value there, but by and large, whether you're talking US treasuries, whether you're talking US corporate paper or UK government gilts or Western Europe government bonds, or let alone the kind of horror story that is the Japanese government bond market, there is no point holding those assets because there's probably no part of the yield curves of any of those markets that give you a positive real return. They're all giving you a yield less than inflation, right. Certainly less than genuine inflation rather than the sort of the myth of inflation that governments tend to sort of perpetuate.
Oh, well, and don't forget taxes too. Yeah, so I mean, you're getting a return of 30 basis points, and you're going to lose X percent off the top just for taxes, and then your net rate of return, you're going to lose all of that and more to inflation. So now you're minus 2%, 3%. I mean, it's you are 100% guaranteed to lose money, and the amazing thing about it is that most of these governments that you're loaning money to, I mean, they're in debt up to their eyeballs to past the point of no return. They can't possibly pay it back, and yet it's still considered to be risk-free.
There's a chart that we use from a company called Church House. It's an asset management group in the UK, and it's a history of the UK base rate going back to the 1694, which is when the Bank of England was established. And UK base rates, our sort of core lending rate, has never been this low in 300 years. And it's broadly the same in every other major bond market. Now, that's kind of perverse, given that the UK's never been this heavily indebted. And, you look at where Japanese government bond yields are, and they're sub 1%. And the Japanese government has never been more heavily in debt. Now, you think about that just for a second, you think, why is it that, at the least value point in that market's history, it's most expensive. It's the most expensive level. Right. Now, one thing, and again, I'm not dissing Buffett at all. One thing he said, which is absolutely correct, is if you can't work out who the patsy is at the poker table, the chances are it's you. Or another way of putting that is, if you don't understand the rules of the game, maybe it's best not to play. Mm-hmm. So the concern I have is that you've got this gigantic asset class, namely debt markets globally, and they completely dwarf the market capitalization of listed stocks. So it's a much bigger market in capital terms. And, in the UK and in the US, chances are the next move in interest rates is going to be up. And if there is one iron law in finance, it's if interest rates go up, bond prices go down. And because you've got this gigantic market that's been inflated in price terms, this is a bubble that is going to burst. We don't know quite when, and clearly central banks will do everything they possibly can to prevent that bubble from bursting. But you cannot buck the market forever. So that's the thing and I think this leads us back to gold. I'm not claiming that gold is the be all and end all. It's the perfect solution to all these problems, but it's surely a better form, a long-term form of preservation of capital and purchasing power, because it's not just fiat money that's just cascading from the heavens. It's it's the valuation of pretty much all parts of the global bond market. This is an accident waiting to happen.
I think one thing that a lot of people get caught up in with gold is they look at gold as an investment class, as an asset class, as opposed to really a form of money. And I think when you look at something as an asset class, people buy stocks and they buy bonds and they these sorts of things. They buy property, and the whole point is, in many cases, they're really speculating. They're buying shares of Google and Apple and Facebook or whatever they're buying. They're trading paper currency for those shares, hoping that those shares go up in value. They can trade those shares back for even more paper currency later on. And I think when people have that view and they hold that view with gold, to me, it defeats the purpose of owning gold to begin with. The whole idea with gold is that you trade paper currency for gold. So the idea of trading gold back for yet more paper currency really defeats the purpose altogether of holding it as a form of money that is, there inherently to preserve the purchasing power of your savings. This is my concept of savings is, if you have, X number of dollars, euros, yen, renminbi, whatever in your savings account. I mean, something's actually savings. I view savings something that's very, very long term. And if that savings X, right now buys you 1,000 loaves of bread, then the idea is that, 10 years from now, 15 years from now, you have 1,000 loaves of bread worth of currency still in your account. You'd still be able to buy 1,000 loaves of bread with whatever that currency buys you. And so that's the point, is that gold has a very long-term track record of being able to keep up with that, month in, month out, and maybe even over a period of a year or more. That doesn't necessarily hold true, but over the long term, it has always held true all throughout history. Anything really above and beyond that, if you're trying to basically be able to derive more loaves of bread, now you're getting into investing in speculation and so forth, which is a different animal altogether. And there's different asset classes that people can get into. People buy stocks and bonds, and I personally am into private businesses. I want to ask you the question. You were talking about different markets that you think are fairly valued or even undervalued right now. Where are those?
We tend to look at the world through a few prisms, and so we sort of split the world up into a variety of asset classes. High quality credits or high quality bonds, if we can find them, and we're having real trouble finding them now. Defensive value equity, listed equities, and there are pockets there that the markets we think are most attractive are predominantly in Asia now. We don't look at markets per se. We tend to try and focus on individual stocks or try and find managers who are capable of identifying those stocks. So the two probably we think that the most explicit, quote, value, unquote, stock markets now are Japan and maybe to a lesser extent Vietnam. There's clearly a frontier market aspect to the latter. We also look at uncorrelated assets, things like hedge funds, specifically trend following funds, which have also been in something of a sort of a cyclical slump for the last 2 or 3 years, but we think they'll come back if you ever get a slightly more normalized interest rate environment. And the last component part, the fourth piece of the jigsaw is real assets, and included within that is the likes of gold and silver. And you mentioned sort of gold being treated as an asset class, and I think there is a risk in that. The thing about gold is, I think gold is a fundamentally more tricky thing to understand than a bond or a stock. One of the teachings of the so-called Austrian school is that all value is subjective. And one of the best definitions of gold that I've heard from an Austrian fund manager is gold is not even an investment. It's a conscious decision to refrain from investing until we can return to a more honest monetary system.
Sure. Yeah, I mean, I think that's a great definition. And we were also talking about this the other night. Is that I'm very bullish on how this all really ends up in the future, because all the concepts, the paradigms, the technologies, everything exists today to essentially make the current system of money and banking completely obsolete and irrelevant. And I think it's really just a question of adaptability. How long does it really take for most of Western civilization to actually embrace and adopt the technologies that mean that all those systems go away? There's obviously gold has a very long standing tradition, and I think even the system itself is already obviously moving towards that. I mean, there have been so many heads of states and finance ministers and central banks out there in the world that have said, very clearly. The French, the British, the Canadians, saying it's time for us to move past this dollar-dominated, money system. And so they're looking obviously at other options, other alternatives. A lot of central banks that are stocking up on gold right now. I mean, it's so clear. I mean, if people are just kind of willing to open their eyes to it, I mean, all the data, the events, I mean, it's all right there. It's all happening in front of our very eyes. And I think that's one of the biggest stories in the world in our modern times. Really, I think we're actually, I think, quite privileged to be living in this time because we're undergoing such a massive transition. The world's biggest superpower is in decline, and that power, that wealth and power is shifting, and the monetary system that's been in place for decades. I mean, realistically, the idea of fractional reserve banking in this in this fiat system has been in place fractional reserve banking has been legalized in the United States for 100 years now. With the advent of the Federal Reserve, I mean, all this is changing. And we have a front row seat to really experience it. And I think people that understand this, this transition and recognize it and just are willing to open their eyes and embrace it, I think there's actually significant upside for people who do understand that, who do understand, where these long-term trends go. And I think, unfortunately, people that don't understand that and they look at, let's say, mainstream financial media, not mentioning any names, they're just, the talking heads that tell them, jump into the markets, buy the all-time high, King Dollar, and I mean, all these sorts of things. I mean, I think they're just really setting themselves up to be utterly destroyed. I guess the one thing that's interesting about it is that you and I both know a lot of people in finance, obviously, and there are certainly, I think, some people, even in professional finance, institutional investors, fund managers, bankers, and so forth, that might, invest with blinders on and say, there's nothing bad to see here, everything is fine. I think a lot of people obviously recognize that stocks are in a bubble and that fundamentals don't really matter anymore, and that it's just a question of Janet Yellen's going to wake up tomorrow and to print or not to print, and that's the only question that counts. And I think a lot of people recognize that, and yet they still invest. They put everything they have into the market. And I'm not sure if that's capitulation because everybody recognizes there's no other options, or my own theory is that the fear of missing out is far greater than the fear of loss. And everybody just kind of presumes that interest rates will stay low, at least for some time, that they'll be able to telegraph exactly when interest rates are going to rise. And at that point, they'll be able to take all of their money out. And essentially time the top of the market. Of course, anybody that thinks they can time the top of the market and then pull their money out, I mean, that's really, really dangerous because obviously every historical case of market crashes in history shows that nobody can really time the market. It's just not possible. But even if that were true, right? Even if there were actually some kind of hair trigger sensitivity that everybody would be able to get out of the markets at exactly the top, think about that when all of a sudden the sort of word on the street is that the market top is in, how much capital is going to be pulled off the table so quickly. And think about how massive that decline is going to be when everybody sort of simultaneously says, yep, that's the top. So, I mean, even if it were true that people could time the top, that the subsequent decline would just be extraordinary. And I think that's, as you mentioned, there are quite a lot of obvious perils out there that most people just seem to be oblivious to.
That point about market declines, I think, is a very astute one. It's a very relevant one. I'm trying to think back to what the levels were for, say, the NASDAQ during the dot-com boom and subsequent bust. And I've got a feeling the top was around 5,000.
5,000, yeah.
But the thing is, not everybody got out at 5,000. There was probably one lucky guy or brilliant market timer who got out at 5,000. But for everybody else, by the time they wanted to get out, the market was already at 4,000 or 3,000.
A relevant analogy was, I think, the real estate market in the U.S. When the bubble burst. I was actually spending quite a bit of time in Florida back then, and I would go around talking to real estate agents. And the sort of lie that everybody would tell themselves is they would come up with these little kind of pithy aphorisms. They'd say, because everybody was convinced that real estate always goes up and that it's just a question of waiting it out. And people would say things like, yeah, we're just waiting for the market to catch up. And it sounds nice, but you look at that and go, what does that actually mean? Waiting for the market to catch up. I mean, I don't even understand what that means. It's just a nice thing that you tell yourself. And so everybody just sort of, becomes this big, this big social circle of brokers who aren't making any money, telling themselves lies, pretending that, it's just a question of, a couple of months and the market's going to come roaring back. And so people always, they end up holding these positions for far too long. They tell themselves these lies. They turn on, they turn on the mainstream financial media, telling them that the market's going to come back and that everything's still strong and there's nothing to worry about and so forth. And these sort of this very strong sense of social proof, these self-reinforcing mechanisms that delude people into believing there's just a temporary aberration and things are going to get back on normal course. And of course, normal course is that markets always go up. And that's just an absurd fallacy. I mean, people living in a fantasy world, which always I think leads to a lot of danger. We're not talking about we're not talking about trivial stuff. I mean, this is people's life savings involved. This is retirement pension funds and people's life savings. I mean, this is important stuff. And to think that it's all just being wantonly thrown into frothy markets at all-time highs, and this is the whole thing is incredibly dangerous. So, what would you say to somebody who's listening to this, thinking, okay, wow, obviously I need to do something with my finances. I need to call my broker. I need to call my money manager, my financial planner. What are the things that you would, really tell people to do? What's kind of the appropriate? It's always a difficult question, and there's no such thing as blanket advice that sort of applies across the board because every situation is different. But with respect to sort of the system as a whole, what are the sorts of things that people need to be thinking about? Sorts of questions they want to be posing to their financial advisors.
We spoke a little earlier about Buffett, and apparently one of the more revelatory things that he said. This may have been at a meeting of Berkshire Hathaway shareholders, but somebody asked him, "Mr. Buffett, what's your biggest regret?" And apparently Buffett's reply was, "I wish I'd started thinking like an owner sooner in my career." So Warren Buffett has this great and deserved reputation for being a sort of stock picker and sort of stock trader, if you like. But I think the real insight into his mindset is. And I think this is the way investing tends to go, particularly for people who are in the capital markets. I think you go through potentially 3 stages. You start off on your sort of first day in a city job or in a Wall Street trading job. You start off as a trader and you have a trading mentality towards everything. So you have a view on everything and everything has a price and you try and buy it at a low price and sell it at a high price. And that's how pretty much everybody, I think, starts out in this business. And then I think maybe a more sophisticated approach over time, you start to think a bit more like an investor. You narrow your field of view. So you no longer try and have a view on everything and view everything as something that can be traded. You start to be more selective in terms of what you're looking at. So you no longer have a view on everything. You start to specialize and focus on things that are closer to you, that are closer to your margin of your zone of comfort, if you like. And then I think the optimal place, the sort of the nirvana state for any investor is you start to think like an owner. So you stop looking at the market as something to be exploited and throwing at situations necessarily. You start to you focus even more intensely on a few key areas that are areas that you know about, that you get to familiarize yourself with, and that become comfortable knowing a bit about. And thinking like an owner, I think, is an aspiration that everybody should take. Whether you're looking at, whatever asset class you're looking at, thinking like an owner is the best possible way to think. So it gives you a longer term perspective that's focused as much on capital preservation as it is on simply making a fast buck. So the advice I would give anybody would be, don't restrict yourself to any one area. In our own model, we say we look at four types of assets, and because we don't know what the future holds, we try and allocate across all of them. High quality debt, high quality listed equity, uncorrelated assets, and real assets, including the likes of gold and silver. But in any case, what the best advice I could make, and it's something I aspire to doing myself, would be think like an owner not like a trader.
Yeah, it's as if instead of when you're making investments, instead of looking at the stock and the stock price and even worrying about that so much as just looking at businesses that you would actually like to own, as if buying a stock meant that you were buying 100% of the business and owning the business. What are the productive and incredibly profitable and lucrative businesses that you could own? And that's, frankly, for me, that's one of the reasons why I invest in private businesses, because the valuations are obviously so much more attractive, and in many cases I can actually have a tremendous amount of influence in what the companies do. I can ring up the CEO and we can have discussions about where the company's headed, and give some input on direction and so forth. And for me, that's a level of comfort that I have, as opposed to investing in big giant bureaucracies. But everybody has their own, I think their own niche and the things that they're comfortable with. But yeah, I think that's really great advice. Actually, looking at the business as a whole, as opposed to worrying about the stock itself and trading that in and out for more paper currency. Well, that's great. Tim, I really appreciate it, as always.
Thank you.
Very insightful, very entertaining. I hope you'll be back on Monday with
we will.
with your normal column. We could all rest a little bit easier, and really appreciate it. I think we will definitely be hearing a lot more from Tim Price in the near future, and more to follow on that. So thanks, everybody, for listening, and we'll talk to you again very soon.